Hello guys, this is Shoaib Yaqoob. Welcome to the discussion of a new question. This is Selorne Company and this is a question from September 2018 attempt. Let's start with the requirement. Let's have a quick look at the requirements. Estimate the equity value of the combined company and the expected additional value arising from the combination of Selorne Company and the Chavan Co. So we need to calculate the equity value of the combined company. Obviously, it will be from one of the method from which we can calculate the combined value, and the expected additional value we can calculate by deducting the individual values of both companies from the combined company. Okay, estimate the share of the gain from the combination created for Chris Chavan and the share of the gain created for Selorne Company shareholders and comment on your findings. So we have to calculate the total synergy benefits, and then we will divide those benefits between the shareholders of the Chavan Co and the Selorne Company. Okay, what about the B part? Evaluate how reliable the estimate of the synergies for the combined company. In this part, we have to discuss with the pros and cons that how reliable the estimates of the synergies for the combined company are likely to be, and discuss the factors which may prevent the forecast synergies from being achieved. These are 7 marks. Next part, discuss the factors which Selorne Company board will consider when determining which source or source of finance are chosen to finance a possible cash bid for the share capital of Chavan Co. So in this part, we have to discuss about the source or source of finance, that which source of finance is the best in order to raise cash for the bid. Okay, let's have a look at the question. Selorne Company is one of the biggest removal companies in Poland, offering home and business removals. It has a number of long-term contracts with the large businesses, although it has not won any new major contract in the last 2 years. Company is listed in the Poland stock market, so it is a listed company, but it is a smaller company. Selorne Company is financed by a mixture of equity and short and long-term debt, but its gearing level is below the average for its sector. So there is a debt capacity available. Selorne companies have 4 executive directors, which each own who each own 20% of the company share capital, and with 20% owned by the external shareholder. Selorne companies have paid a constant dividend since it has been listed, and its share price has risen slightly over the last 3 years. Company is based on a number of large cities and towns in Poland and on the majority of the sites where it is located. Many of its employees have worked for the company for a long time, so employees are loyal. Drivers of the lorries used by the Selorne Company are required to have a special heavy vehicle license. Salary level at the Selorne Company are relatively high compared with the other companies in the sector. So employees are satisfied, the salary levels are up, and they are working here for since long time. Chavan Co. Selorne Company is currently considering making a bid for the Chavan Co, an unlisted company specializing in distribution and delivery services. Company is owned 100% by its founder Chris Chavan. Company has built up a portfolio of small contracts over time. It has made unsuccessful bids for 2 larger contracts over the last 12 months. The bids being rejected primarily because Selorne Company was not felt to be big enough to be able to guarantee the level of services required. So once we have acquired this company, definitely we have a chance to have to make a successful bid for the larger contracts, because after acquisition of the Chavan Co, Selorne and the Chavan Company size will become larger, and with a bigger size you can go for the bidding of the larger contracts. Chavan Company is based in many of the same cities and towns where Selorne Company is located. Although Chavan premises are all rented, so we can save those rents energy. Driver of the Chairman Company vehicle do not require a heavy vehicle license. Chairman Company has a few long-serving employees who are mostly center managers. Most of its driver and staff, however, stay at the Chairman Company for a only short time. So employees are not satisfied with the company policies. Salary levels are low, although company pays high level of overtime and high bonuses if the target profits are achieved. But still salary levels are low, so the confidence, the morale of the employees are very low. So when company is highly geared, leading to recent media speculation about its financial viability. So its debt capacity is very high. So sorry, it's not debt capacity, its debt level is very high. Terms of bid for the Chavan company. In initial discussion about the acquisition, Chris Chavan indicated that he would prefer to consideration to be share for share exchange. The terms being one company share for 5 Selorne company shares. Chavan company is a $2 million $1 shares in issue. So in order to acquire 2 million, we have to issue 10 million shares. And Selorne company has 50 million shares in issue. Each Selorne company is currently trading at 6.5. The market value per share is given, which is a multiple of 8 of its free cash flow to equity. So price to cash flow ratio of 8 is also given. Multiple of 8 can be assumed to remain unchanged if the acquisition take place. Chavan company free cash flow to equity is currently estimated at 7 million with an expected annual growth rate of 3%, and it is expected to generate a return on equity of 15%. Okay, next, Chris Chavan expect that total free cash flow to equity of the combined company will increase by 5 million due to synergy benefits. He believes that, so by looking at the information, just try to think about the combined method which you are going to use to evaluate the worth of the combined company. As price to cash flow ratio is given, free cash flow to equity is given, synergy in terms of cash flow is given. So from the given data, we can predict that we can calculate combined value using FCFE model. Combined FCFE model. Okay. He believed that Selorne company will be able to win more contract because it is larger and because it will be diversifying into the services which it offers. He also believed that significant operational synergies can be achieved, pointing at the time Selorne company drivers spent idle during the winter months when removal activity is traditionally lower. So we can give them the distribution and delivery services. Chris Chavan believes that he can achieve the synergies if he is given management responsibility for the operational organization, including dealing with the staff employment and retention issues. That will be an issue because Chris Chavan is not famous for retaining the employees. He's not famous for giving a big salaries to the employees. So employees' morale can be down as we appoint Chris Chavan as the uh, ha having a management responsibility. Chris Chavan thinks that synergies could also be achieved in central administration and in premises cost. Okay, the chief executive and the finance director of the Selorne company are in favor of bidding for the Selorne Co. However, one of the other executive directors is opposed to the bid. He is skeptical about the level of synergies which can be achieved and does not want Chris to be brought into the management of Selorne company. He suggests that if the bid is to go ahead, it should be a cash offer rather than a share exchange. Okay. CEO has responded that Chris is likely to ask for a higher equivalent price if the purchase is for cash. Selorne Company Finance Director has pointed out that Selorne Company will need additional funding if Co is purchased for cash. He has suggested that there may be a number of possible sources of finance, including right issue, bank loan, mezzanine loan, convertible debt. Okay, let's solve the first part, estimate the equity value of the combined company and the expected additional value arising from the combination of Selorne company and the Churn Co. So we have to calculate the individual value of the Selorne company first. Its individual value was $6.5 per share. into 50 million. And it will be 6.5 into 50, 325. Okay, and price to cash flow ratio is given. Price to cash flow ratio is 8 times. 8 times. So price is given. Price to cash flow is given. We can calculate the free cash flow, FCFE of Selorne company. That will be 325 over 8. And it will be 40.65 million. Okay. What about the market value of Selorne Co? Free cash flow to equity is given, that is of 7 million. Growth is given. Cost of equity is given 15%. 7 million into 1.03 divided by 0.15 minus 0.03. So the market value will be equal to 7 into 1.03 divided by 0.12. It will be 60 million. Approximately $60 million. So what about the combined company? In order to calculate the combined company, first of all calculate combined FCFE. FCFE of Selorne company is 40.625 plus 7 million plus the 5 million synergy benefits. So it will be 52.625. Okay, the combined value will be 52.625 into 8. Combined value will be 421 million. Okay, now deduct the individual values. $325, 60. So 36 million will be synergy benefits. Okay, now we have to distribute 5 Selorne company shares to the against the 2 shares of, sorry, we have to distribute how many shares? We have to distribute 5 Selorne company shares for 1 share of Selorne Co. Okay. What about the combined market value per share? Okay, the combined market value will be 421. The combined value divided by the existing number of shares, that is of 50 million of the Selorne company, plus for every 1 share of Selorne Co, every 1 share of Selorne Co we are offering 5 million. So 421 divided by 60 million, that is 7.02 dollar is the combined value. So what about the gain? Okay, about the share of the gain from the combination. What is the B part? Estimate the share of the gain from the combination created for the CRIS and the share of the gain created for the Selorne company shareholder and comment on your result. Okay. What about the CRIS? Okay, what about the CRIS one? Now, CRIS is receiving value offer. We are distributing 5 shares having value of 7.02. So we are offering 7.02 into 5, 35.1. And the previous value was value of target. 60 million was the total value and 2 million was the share, 30. So previous gain is $5 and it is 5 divided by 30. It's 16.67 percentage gain. And what about the Selorne company gain? Post-tax value is pre-tax value. Post-tax value is 7.02, pre-tax was 6.5, 0.52, 0.52 over 6.5. Gain is approximately near to 8%. That's how you can calculate the percentage gain or percentage return. There is another way of calculating the same gain, that is of total. How can you calculate the total gain and for both of the companies? Like for the CRIS, we have offered our we have offered 5 shares for every share of the Selorne Co. Selorne Co has 2 million shares. That means now after the acquisition, Selorne company will be having 10 million shares in a combined company. So total value of Selorne share, 10 million shares at 7.02, $70.2 million worth is transferred to the CRIS company, CRIS Selorne. Okay, what about its previous share? Previous worth was 60 million. So 10.02 is the gain. And in terms of percentage, it will be same like 16.67. And what about the total synergy? Total synergy was 36 million. And out of 36, approximately 10 million transferred to CRIS. So the remaining 26 million is a gain to Selorne company shareholders. And if you divide this 26 over the previous value of Selorne company shareholders, that is 325, it is approximately equal to 8%. So you can calculate the percentage gain by calculating the total gains, or you can calculate the percentage by calculating the per share gain of both target company and the both acquirer. Let's move to the B part. Evaluate how reliable the estimates of the synergies for the combined company. If we have to discuss on the reliability of the estimates and discuss the factors which may prevent the forecast synergies from being achieved. Okay, there's a lot to discuss in this part on the reliability and the problems which will restrict us to achieve those forecast synergies. After reading the requirement and the scenario, there's a lot of problems and lot of uh, estimation problems which can be identified from the scenario. Like if we would have won larger contracts, definitely we will achieve the synergy benefits. If both of the departments employees integrate with each other, definitely we will achieve some synergy benefits. Okay, the integration will create some synergy benefits. Obviously, the operational integration will create some synergy benefits, and size of the company will give us a chance to win larger contracts. So there are a lot of potential to earn synergy benefits, but obviously there can be a lot of problems, and those problems will restrict us to achieve those synergy benefits. Let's read the answer. Okay, reliability of synergy benefits. The reliability of synergies estimates may vary depending on the synergies involved. Synergy relating to size and services offered will depend on the ability to gain large contracts, and neither company has had recent success in doing this. Not the acquirer, not the target company have won the large contracts since recent times. However, the contract recently bid for the Selorne Co might have been won if the larger combined company had bid. The synergies relating to the operation and working practice may be difficult to obtain if it is difficult to change the employment condition. Claims that improved driver utilization may reduce spare capacity may be true, but there is a likely to be less spare capacity anyway if more contracts are won. Because if we win more contracts, definitely drivers will be busy in carrying out those contracts. Other synergies may be easier to obtain. Duplication of premises in some locations should be eliminated easily. Forwarding company does not have onerous rental contracts, and there is space on the Selorne company side. Combining central administrative function should reduce some staffing costs, although these are likely to be smaller synergies. Okay, there are some synergies relating to size, there are some synergies relating to integration of employees, and there are some administrative or rental synergies. What are the problems? Significant problem may be lack of unity at the top management. Company directors are not all keen on the acquisition, and this may spill over into being unable to agree on a clear post-acquisition plan. So there's a lack of unity. Okay, Chris' role in the combined company may also make synergies difficult to achieve. He will have a significant shareholding in place on the board, so it will be difficult for the Selorne company to ignore him. Possibly he has the ability and desire to achieve synergies, desire to achieve changes in the operational practices which other board members lack. However, if Chris is being the leading role, there may be a change in management style, and that will be devastating for the previous employees because it will hurt their confidence and their loyalty. Some may leave, jeopardizing the continuity, which seems to have been an important part of the Selorne company's success. Another reason for possible problem with staff is the differing remuneration arrangement. Acquired company staff may have stayed with the company because both their job prospects and their remuneration have been safe. Attempts to change the employment condition may lead to resistance and employee departure. Ex-Selorne company employees who have been with the company for a while may expect salaries to be increased as well. And if this happens, definitely the staff cost or the bonusing cost will increase. Success of the acquisition may also depend on how well the staff of the two business integrate. Integration may be difficult to achieve. Many of the Selorne Co staff will not have the necessary license to drive the big lorries and may not wish to go through the process of obtaining the license because everybody normally oppose the change. Salon company drivers may be reluctant to drive the smaller vehicle. Staff sticking to what they have been used to driving is likely to prolong a them and us culture. Obviously, it will cost the company more. Okay, that was the problem which company may face. Let's move to the C part. Discuss the factors which company board will consider when determining which source of finance are chosen to finance a possible cash bid. So what factors which are we going to discuss in order to select the right issue? Bank loan, mezzanine debt, conversion rights. Obviously, there can be a different factors. Let's discuss those factors. Factors can be the availability, cost, director's preference, control. Okay, what about the availability? Although the finance director has identified possible source of finance, there is no guarantee that they will necessarily be available. Success of a right issue may well depend on the willingness and ability of the directed shareholder to subscribe. Obviously, this company has mainly four main directors having the 80% shares and one external shareholder having the 20% shares. So it all depends on the willingness of those directors, that either they are willing to provide more cash to the company or not. It may be difficult to find others willing to take up the director right if they do not subscribe, as the director unwillingness may be seen as indicating a lack of confidence in the business. Right issue may also take longer time to arrange than other methods, which may be significant if certain company needs to finance quickly to complete the acquisition. Obtaining a bank loan or mezzanine may be difficult if Stone company takes on Chowan company debt, because as we acquire the Chowan company debt, our gearing will automatically will rise and it will be difficult for us to obtain more loan. Cost will be another factor. If we acquire funds from the right issue, definitely it will be more expensive. And if we take debt, debt is a cheaper source of finance, but in this case, as we have already having a high level of gearing, definitely debt we will arrange debt at a higher cost. So the cost of equity will normally be viewed as higher anyway than the cost of debt. Issue cost of the equity are likely to be higher than cost of debt. As long as company share price is stable, its current external shareholder appear content with the dividend paid, so there does not appear to be pressure to increase them. In any case, the board is not required to pay dividend every year. Definitely, expectation will be on the higher side, but dividend dividends are discretionary. Fixed interest cost on the bank loan may become burden if the interest rate falls, but the cost can be forecast with certainty. As the mezzanine finance is unsecured, it is likely to have a higher interest cost than the bank loan. Okay, what about the in convertible debt? We can give the lower interest rate because we have attached the conversion feature, but it all depends how attractive the conversion feature is. If the conversion feature is very attractive, Chris Chavan will definitely select the convertible bond and we have to pay lower interest. What about the director preference? The choice will also be determined by the Salon company board attitude to gearing as well. Are they willing to take more loan? Are they willing to accept the more gearing, the risky company structure? If yes, company will definitely go for the debt. If not, then right issue will be a more probable choice. Board may feel that strong company has reached or exceeded the gearing level which it would regard as desirable by taking on Chowan company debt. If this is the case, board would have to use the equity finance. Board may also be influenced by how gearing is likely to change over time. Over the next few years, gearing may fall as a Sloan company makes profit. Sloan company debt may be repaid and not replaced. The convertible debt and mezzanine finance will also not a long-term source of debt finance. So if they choose the convertible debt, definitely it will increase the gearing in earlier part of the loan, but once the debt will be converted into equity, gearing level will reduce. The board decision may also be determined by the implication of the different source of finance. If they do the right issue, definitely there will be no impact on the control. But if they issue convertible debt, once the conversion has been done, definitely it will dent on the control. The control of existing shareholders will be diluted and more control will be shifted to the Chris Chavan, which few directors are opposing. So what should we do? Mix of finance. Ultimately, the board may also consider the possibility of mix of finance. The offer could be backed by a core of equity finance from a right issue, but if Selorne company has to pay a higher price than expected, the difference could be made up by the mezzanine finance. Okay, examiner is clearly stating the credit will be given for alternative discussion. So in order to choose from the right issue, the equity, debt, convertible debt, mezzanine debt, we have to look upon the following factors: availability of debt, cost of debt, time to arrange debt, issuance cost, and obviously from the control perspective and from the director preference. So these are the factors which we should consider before selecting any suitable source of finance. Okay, thank you so much guys. That is all for today's set of questions.